Hello guys, Jeff here. Welcome to the Intelligent Investor. In today's video, we're going to look at PE ratio, or the price to earnings ratio. The PE ratio, or the price to earnings ratio, is a valuation metric that is used to compare a stock's current price to its earnings or profits. The PE ratio, or price to earnings ratio, tells you how much of a premium you are paying to get exposure to a company's profits. The price to earnings ratio can be used to understand whether the market is currently placing a high or low price on a stock based on the money and profits a company is generating. In general, stocks with a low PE ratio, for example 10, would imply that the stock is relatively cheap compared to its profit. On the other hand, stocks with a high PE ratio, for example 50, would imply that the stock is currently expensive compared to its profits. In order to calculate the PE ratio, take the price per share and divide by the earnings per share. The output from the PE ratio calculation will result in something called a multiple. For example, 20 times. If you hear someone referring to a stock's multiple or the earnings multiple, this is what they are referring to. The PE ratio is only really useful when comparing companies from the same industry, as different industries have different standards. For example, it would not make sense to compare the PE ratio of Amazon to that of McDonald's. This is because expectations and growth rates for a restaurant like McDonald's are very different from the expectations of a technology company like Amazon. McDonald's might see more consistent profits but at a lower growth rate, whereas Amazon might see higher profits but experience higher volatility. It would be a much better idea to compare Amazon's PE ratio to the PE ratio of a company like Apple in order to get an idea of this company's valuations. I hope you have enjoyed this video. Kindly subscribe. See you in the next one.